Delving into the company background, Walgreens Boots Alliance Inc. is an American holding company headquartered in Deerfield, Illinois, that owns Walgreens, Boots, and a number of pharmaceutical manufacturing, wholesale, and distribution companies. What is a holding company? A holding company is a company that owns other companies' outstanding stock. Or in other words, it is a company that does not produce goods or services itself, focusing on owning shares of other companies in the form of a corporate group instead. What are the benefits of holding companies? Holding companies allow the reduction of risk for the owners and can allow the ownership and control of a number of different companies. What is Walgreens? Walgreens is the largest drug retailing chain in the United States. As of August 31st, 2014, the company operated 8,309 stores in all 50 states, the District of Columbia, Puerto Rico, and the U.S. Virgin Islands, and had net sales of $76.4 billion in the fiscal year ended August 31st, 2014. What is Alliance Boots? Formerly known as Boots UK Limited and Alliance Unichem. Boots UK Limited is a pharmacy chain in the United Kingdom and Ireland, with outlets in most high streets, also known as popular streets, shopping centers, and airport terminals. Alliance Unichem is a wholesale distributor of pharmaceutical brands. As of August 31st, 2014, Alliance Boots had, together with its associates and joint ventures, pharmacy-led health and beauty retail businesses in 11 countries and operated more than 4,600 health and beauty retail stores, of which more than 4,450 had a pharmacy with a growing online presence. In addition, as of March 31st, 2014, its fiscal year end, Alliance Boots had approximately 600 optical practices in the United Kingdom, with approximately 180 of them operating on a franchise basis. As you can see, Walgreens operates more domestically and in the U.S., while Boot handles international sales. Alliance takes over the wholesale distributor timeline of how Walgreens Boots Alliance was formed. In 1849, Boots UK Limited was founded. Then in 1901, the Walgreens Company was founded. In 2006, the Boots Company merged with Alliance Unichem, a company that wholesales, distributes, and retails pharmaceutical, surgical, medical, and healthcare products throughout Europe, to form Alliance Boots. On August 2nd, 2012, Walgreens bought a 45% stake, Alliance Boots, with the option to buy the rest within 3 years. It exercised this option in 2014, and as a result, Boots became a subsidiary of the new company, Walgreens Boots Alliance, on December 31st, 2014. Under the terms of the merger, the new company would be reorganized into 3 divisions: Walgreens, Boots, and Pharmaceutical Wholesale. Looking into incorporating the 10K Alliance of Walgreens Boots Alliance Inc., we have identified the main lines of business. Walgreens drugstores are engaged in the retail sale of prescription and non-prescription drugs and general merchandise. General merchandise includes, among other things, convenience and fresh foods, household items, personal care, beauty care, photo finishing, and candy. Prescription drugs represent the company's largest class, followed by general merchandise and non-prescription drugs. They also offer pharmacy, health, and wellness solutions, which include retail, specialty pharmacy, infusion and respiratory services, mail service, and convenient care clinics. Their drugstores sell prescription and non-prescription drugs, and their pharmacists provide drug consultations and administer flu vaccines and other immunizations. Customers also have access to e-commerce solutions and mobile applications to fill prescriptions and enhance the user's experience. Alliance Boots is a market leader in the pharmacy industry with stores located in the United Kingdom, Norway, the Republic of Ireland, the Netherlands, Mexico, Chile, Thailand, and Lithuania, and through its associates and joint ventures in China, Italy, and Croatia. In addition, as of March 31st, 2014, there were approximately 80 Boots branded stores operating in the Middle East on a franchise basis. Alliance Boots seeks to locate its stores in convenient locations and to put pharmacists at the heart of healthcare. Alliance Boots pharmacists are well placed to provide a significant role in the provision of healthcare services, working closely with other primary healthcare providers in the communities they serve. Alliance Boots' principal retail brand in his health and beauty division is Boots, which Alliance Boots trades under in the United Kingdom, Norway, the Republic of Ireland, the Netherlands, and Thailand. The Boots offering is differentiated from that of competitors due to a number of factors, including the product brands that Alliance Boots own and only at Boots exclusive products. Alliance Boots has products such as No. 7, Sultan, and Botanics, together with new brands such as Boots Pharmaceuticals and Boots Laboratories. Alliance Boots is seeking to continue to internationalize its key product brands, selling them through select retail partners, its own and third-party internet shopping sites, and independent pharmacies. In the United States, where Boots product brands have been sold for Target for many years, Alliance Boots is in addition introducing No. 7 and other key Boots product brands into the drugstore channel through certain Walgreens stores on a phased basis. In Europe, its Boots Laboratories line of products was sold by independent pharmacies in 5 countries as of March 31, 2014. In addition, Alliance Boots has partnerships with a number of third-party brand owners to sell their products in Boots stores on an exclusive basis, sharing in the future brand equity. Alliance Boots also continues to manufacture a significant proportion of its most popular own brand and exclusive products. Through its pharmaceutical wholesale division and associates, Alliance Boots currently sells Almus, its line of generic medicines in 5 countries, and Alvita, its line of patient care products in 6 countries. Alliance Boots pharmaceutical wholesaling and distribution businesses seek to provide high core service levels to pharmacists in terms of frequency of delivery, product availability, delivery accuracy, timeliness, and reliability at competitive prices. Alliance Boots also offers its customers added value services that help pharmacists develop their own businesses. This includes membership in Alphega Pharmacy, Alliance Boots' pan-European network for independent pharmacies. In addition to the wholesale medicines and other healthcare products, Alliance Boots provides services to pharmaceutical manufacturers who are increasingly seeking to gain greater control over their product distribution while at the same time outsource non-core activities. These services include pre-wholesale and contract logistics, direct deliveries to pharmacies, and specialized medicine delivery, including related home healthcare. While there are many risks, we have identified these 5 as the most high-level risk areas. We first begin by talking about reductions in third-party reimbursement levels from private or government plans for prescription drugs. This could potentially reduce margin on pharmacy sales and could have a significant adverse effect on profitability. In addition, a shift in pharmacy mix toward lower margin plans and programs can adversely affect profitability. Some of these entities may offer pricing terms that the company may not be willing to accept or otherwise restrict their participation in their networks of pharmacy providers, such as with the new and pending Medicaid plan. Next, the introduction of new brand name prescription drugs can be significantly adverse to the company. New brand name drugs can result in increased drug utilization and associated sales revenues, while the introduction of lower-priced generic alternatives typically results in relatively lower sales revenues, but higher gross profit margins. Investments in companies over which they do not have sole control. These new companies may operate in sectors that differ from their current operations and have different risks. Single wholesaler of branded and generic pharmaceutical drugs as a primary source of such products. A disruption in this relationship could adversely affect the business and financial results. Finally, the anticipated strategic and financial benefits of relationships may not be realized. Achieving the anticipated benefits from the arrangement is subject to a number of significant challenges and uncertainties, including whether unique corporate cultures of separate organizations will work collaboratively in an efficient and effective manner, the possibility of faulty assumptions, underlying expectations regarding potential synergies, unforeseen expenses or delays, and competitive factors in the marketplace, such as the acquisition of AmerisourceBergen in 2013. That all business risks are connected to tax, since business risks affect income and income affects the tax rate, we have identified the more relevant tax-related business risks. These include changes in economic conditions, taking on additional debt without retiring existing debt, conversion from IFRS to US GAAP, currency translation, and changes in accounting standards and subjective assumptions, estimates, and judgment by management. While the list for business risks is long, we have condensed it to these 10 points that represent outside factors, while the remaining factors that we have left off the list are more internal factors. We have identified a few key points. In 2014, the company opened and acquired 268 locations. Acquisitions included Cure Drug, which contributed 76 drugstore locations, as well as a specialty pharmacy and a distribution center. In 2014, the company had a net reduction of 273 locations, primarily due to the sale of the Take Care Employer Solutions LLC business, which consisted primarily of worksite locations, and the company's efforts to close underperforming drugstores. Business acquisitions in fiscal 2014 were $344 million versus $630 million during fiscal 2013. Business acquisitions in the current year include the purchase of the Cure Drug and affiliates for $173 million, subject to adjustment in certain circumstances. In fiscal 2014, the company also purchased shares of common stock of AmerisourceBergen for $493 million. The effective income tax rate was 42.9% for fiscal 2014 and 37.1% for fiscal 2013. As you can see, the effective income tax rate has increased from 2013 to 2014. The increase in the effective tax rate from fiscal 2013 was primarily attributed to the loss associated with the company's option to purchase the remaining equity interest in Alliance Boots, which did not generate a tax benefit in fiscal 2014, partially offset by the favorable impact of additional foreign source income taxed at lower rates. The loss will be, in part, a capital loss for tax purposes for which the company did not have any capital gains to offset against and has recorded a full valuation allowance. The capital loss on the Alliance Boots call option is available to be carried forward and offset against future capital gains through fiscal 2020. The consolidated financial statements are prepared in accordance with accounting principles generally accepted in the United States of America and include amounts based on management's prudent judgments and estimates. Actual results may differ from these estimates. Management believes that any reasonable deviation from these judgments and estimates would not have a material impact on their consolidated financial position or results of operations. To the extent that the estimates used differ from actual results, however, adjustments to the statement of earnings and corresponding balance sheet accounts would be necessary. These adjustments will be made in future statements. Some of the more significant estimates include goodwill and other intangible asset impairment, allowance for doubtful accounts, vendor allowances, asset impairments, liability for closed locations, liability for insurance claims, cost of sales, equity method investments, and income tax.
The effective tax rate in 2015 was 19.9%, and this was calculated by total tax provision divided by book income before tax. The company's current ETR was 20.6%. This is an indication of the relative amount of current taxes the company incurs in relation to its book income before tax. Comparing the company's U.S. ETR versus non-U.S. ETR, U.S. ETR is 35% and non-U.S. ETR is 4.9%. And the company did not disclose information about discontinued operations.
Valuation allowances are usually established when it's necessary to reduce deferred tax assets to the amounts more likely than not to be realized. Upon the amendments of the call option to acquire 55% ownership of Alliance Boots, Walgreens Boots Alliance was required to record the difference between the fair value of the amendment option and the book value of its original price with a loss of $866 million. This amount is included in a capital loss of $713 million in state ordinary, which will be more likely than not that capital loss carry-forwards are not realized. As a result, company has recorded a valuation allowance amount of $223 million for 2014, increased from $19 million of fiscal year 2013. In regards to potential changes in its valuation allowances, Walgreens Boots Alliance, in terms of evaluating the tax benefits associated with number of tax filing positions, the company should record a tax benefit for uncertain tax positions using the highest cumulative tax benefit that is more likely than not to be realized. Adjustments are made to the liability for unrecognized tax benefits in the period in which the company determines the issue that is effectively settled with appropriate tax authorities. Therefore, Walgreen Boots Alien's liability for unrecognized tax benefits, including accrued penalties and interest, is included in other long-term liabilities and current income taxes on the consolidated balance sheet and in income tax expense on the consolidated statements of earnings. As presented in the unrecognized tax benefit reconciliation, the ending balance of 2014 decreased to $193 million from $208 million of 2013's ending balance. It's adjusted by tax positions in prior and current period and settled with proper taxing authorities and lapse of statute of limitations. From this result, $105 million of unrecognized tax benefits in 2014 would impact the effective tax rate if recognized. Walgreens assumes that there will be no material changes in the amount of the unrecognized tax benefits during the next 12 months. In the footnote, $21 million of company's interest and penalties are accrued in other long-term liabilities in the income tax provision. Walgreens also disclosed that it's unable to estimate the reasonably possible amount or range of unrecognized tax benefits over the next 12 months under commitment and contingencies.
Now I'll be talking about income tax payable and deferred tax assets and liabilities for Walgreen Boots Alliance Inc. According to the company's balance sheet, the company did not show taxes receivable or payable separately due to the materiality of the company's financial statements. Therefore, income tax payable is recorded under current liabilities in the amount of $105 million. Furthermore, the company's liability for unrecognized tax benefits, including accrued penalties and interest, is included in the other long-term liabilities on the consolidated balance sheets and in an income tax expense in the consolidated statements of earnings. Walgreens Boots Alliance Inc. accounts for income taxes according to the asset and liability method. Under this method, deferred tax assets and liabilities are recognized based upon the estimated future tax consequences attributable to differences between the financial statement carrying amounts of existing assets and liabilities and their respective tax bases. Deferred tax assets and liabilities are measured pursuant to tax laws using rates expected to apply to taxable income in the years in which those temporary differences are expected to be recovered or settled. The effect on deferred tax assets and liabilities of a change in tax rate is recognized in income in the period that includes the enactment date. And finally, valuation allowances are established when necessary to reduce deferred tax assets to the amounts more likely than not to be realized. In determining the deferred tax assets and liabilities, the components of the company's deferred tax assets and liabilities are mainly from tax benefits of $430 million, accelerated depreciation of $1,244 million, inventory of $407 million, equity method investment of $355 million, and deferred income of $208 million. The amount of deferred tax assets and liabilities, which is net of valuation allowances, are $1,155 and $2,278 million, respectively. The company believes that it is more likely than not that the benefit of certain net operating and capital loss carryforwards will not be realized. Therefore, the company has recorded a valuation allowance in the amount of $223 million on a certain deferred tax assets. As a result, the company is in a net deferred liability position, and other than deferred tax assets and liabilities, the company has received the tax holidays from Swiss cantonal income taxes relative to its Swiss operations. The income tax holidays are expected to extend through September 2022. The holidays had an immaterial impact on the company's results during the current fiscal year. And at the August 31st, 2014, the company has had an unrecorded deferred tax liability for temporary differences related to its investment in certain foreign subsidiaries of approximately $85 million.
In regards to accounting for the unremitted earnings of foreign subsidiaries, Walgreens Boots Alliance intends to assert indefinite reversal as the company's policy to account for the unremitted earnings of foreign subsidiaries. As of August 31st, 2014, Walgreens Boots Alliance has an unrecorded deferred tax liability for temporary differences related to its investments in foreign subsidiaries of approximately $85 million. In order to satisfy the policy for indefinite reversal, Walgreens Boots Alliance must intend to show that there is sufficient evidence that a foreign subsidiary has invested or will invest the undistributed earnings indefinitely. If Walgreens can show such evidence, then the deferred taxes do not have to be accrued.
Comprehensive income components disclosed are pension, post-retirement obligations, unrealized on cash flow hedges, unrecognized gain on available for sale investments, share of other comprehensive income of Alliance Boots, and currency translation adjustments. And the total OCI loss was negative $356 million. Items listed in current year statement of shareholders' equities are issuance of shares for Alliance Boots acquisitions, treasury stock purchases, employee stock purchases, and option plans. In the statement of cash flow, the adjustment for deferred tax is negative 32 million. And these deferred taxes mean that deferred tax assets and liabilities are measured pursuant to tax laws using rates expected to apply to taxable income in the years in which those temporary differences are expected to be recovered or settled. The total amount of taxes that company paid during is 10,056 million, which is the total tax provision.
Just a few weeks ago, there was a recent announcement of a merger between Pfizer Inc. and Allergen plc for the purposes of tax inversion. And this announced merger has led to the push for stricter laws that will make it more difficult for companies to move their tax addresses overseas when acquiring a foreign company. Pfizer and Allergen are also part of the pharmaceutical industry, much like Walgreens Boots Alliance. And the push for stricter laws to prevent tax inversion can actually affect Walgreens Boots Alliance. Part of tax inversion is a process known as earnings stripping. Earnings stripping occurs when a company moves its earnings from a high tax jurisdiction to a low tax jurisdiction. It is also the process of using debt from overseas company to decrease taxable income in a high tax jurisdiction area such as the United States. In order to prevent earnings stripping, the Treasury Department has made moves to enforce new rules that will make it more difficult for companies to use this practice. Since Walgreens Boots Alliance is a global company and it has operations all over the world, it definitely uses earnings stripping as a way to reduce its effective tax rate. If the Treasury Department pushes for regulations that can prevent earnings stripping, Walgreens Boots Alliance may have to face higher tax consequences in the future. These changes in tax laws may cause Walgreens Boot Alliance to see an increase in its effective tax rates, as more of its income will be taxed at the higher U.S. tax rates as opposed to the lower tax rates overseas if it cannot use the earnings stripping method to reduce its tax rates.